Hi, I'm Matt Sampson with ILS Financial. High income creates momentum, and momentum can hide inefficiency. As earnings increase, most professionals naturally do the right things. They increase retirement contributions. They add taxable investment accounts. They participate in employer plans. They diversify across asset classes. From the outside, everything looks healthy. But here's the issue: progress and efficiency are not the same thing. You can be moving forward while still leaking value. And those leaks don't show up as dramatic losses. They might show up as slightly higher taxes every year, slightly lower after tax returns, slightly more friction when decisions need to be made. Individually, they seem small. Over time, they compound. The high income blind spot is not ignorance, it's fragmentation. As income rises, complexity likely increases across several dimensions at the same time. Multiple account types: taxable, tax deferred, tax free, variable compensation, bonuses, overtime, equity, business income, higher marginal tax rates, longer term planning trade offs. The problem isn't that these pieces exist. The problem is that they're often managed independently rather than as parts of a single system. When accounts, strategies, and decisions aren't coordinated, inefficiencies begin to stack quietly in the background. One of the least visible, but most powerful forces in long term outcomes is tax drag. Tax drag is simply the reduction in returns caused by ongoing taxation on interest, dividends, and realized gains. For high earners, this effect is magnified by higher federal marginal tax rates, state and local taxes, the net investment income tax, portfolio turnover in taxable accounts. Academic research has consistently shown that after tax returns, not pre tax, are what ultimately determine outcomes. This has been explored extensively in work by economists like James Proterba. Even a tax drag of 0.75% to a percent annually may not feel dramatic in any single year, but over decades, it can materially change the end result. And because it happens quietly, it's so often ignored. Most investors are familiar with asset allocation, what you own. Far fewer spend time on asset location, where you own it. Account types are taxed differently. This distinction is clearly laid out by the Internal Revenue Service, but in practice, assets are often placed based on convenience rather than intention. That can lead to tax inefficient assets sitting in a taxable account, tax efficient assets being sheltered unnecessarily, missed opportunity for deferral or tax free growth. Two portfolios can look identical on paper and produce very different after tax outcomes depending on how assets are located. This isn't about complexity for its own sake. It's about acknowledging that where assets live matters just as much as what they are. Another common issue is confusing how a portfolio looks with how it actually functions. True portfolio structure accounts for things like after tax expected returns, liquidity needs, cash flow timing, rebalancing mechanics, behavioral risk tolerance. Two portfolios might appear diversified, yet behave very differently once taxes, withdrawals, or market stress enter the picture. This idea is closely related to the work of William Sharpe, who emphasized that outcomes are shaped not just by assets, but by arithmetic realities and constraints. Structure matters more than appearance. As complexity increases, coordination likely becomes more important, not less. Employer plans, IRAs, taxable accounts, pensions, and business assets are often managed in isolation. That fragmentation can lead to redundant exposure, conflicting strategies, inefficient withdrawal sequencing, poor alignment with long-term goals. Each account might be reasonable on its own, yet the system as a whole becomes inefficient. The cost isn't obvious. It may show up slowly over time, in friction, missed opportunities, and unnecessary trade-offs. At lower income levels, simplicity often works. At higher income and asset levels, marginal mistakes are larger. Tax inefficiencies compound faster. Structural errors become harder to unwind. Opportunity cost increases. This is where many people unknowingly transition from accumulation to optimization, not because they're doing something wrong, but because the rules of the game have changed. Rather than asking, am I beating the market? More useful questions might be, are my assets intentionally located across account types? Do my investments reflect after tax outcomes? Is my portfolio aligned with real cash flow needs? Are my accounts coordinated towards a single strategy? Can I explain why each piece exists? If several of those answers are unclear, the blind spot may already be present. The high income blind spot doesn't announce itself loudly. It compounds quietly. Addressing it usually doesn't require radical change, but it does require intentional structure, coordination, and an after tax perspective. For those willing to examine how the pieces fit together, the opportunity isn't higher returns. It can lead to better outcomes.